Dive into the basics of an income statement. So an income statement is basically when a company has their list of sales and expenses, it's aggregating the numbers for a certain time period and categorizing them to make it in a presentable format for investors. Um, and we're going to go through the basics of an income statement right here. Easiest way to learn this is through a sample business. So let's take a t-shirt business. Just imagine a small private company that makes t-shirt. So from somewhere else, they have a list of all their sales to their different customers, and we're going to say a common time period might be for a quarter or a year. So let's just say we're pretending for a year. So we're just going to say for the year of 2025. All right. So sales or revenue is where income statement starts. And this is just going to be an aggregate of all the sales that they've had. And let's say this t-shirt business sold $12,000 worth of material. Um, Again, when you're dealing with these numbers, it's nice to be able to format these things so they look nice. So I'm blocking in all this whole section right here, and I'm formatting it with the dollar sign, with the comma, just to make it easy and presentable to watch. So that's our sales. So again, it's an aggregate of all of the individual sales that they made. Now, cost of goods sold is the direct expenses that are spent for making those t-shirts. So this is specifically things like maybe they purchased the blank t-shirts from a wholesaler, and then they use ink to print their customized graphic on these t-shirts that are then sold. So buying that blank t-shirt, the ink used to print, these are all specifically direct expenses related to the sale of those items. And let's say when they look through all those things, they're spending $4,000 for those things. All right. Now, what's the gross profit going to be? That's the difference between these two. So I'm going to say equals this formula, this number, minus this one. So in this case, that's $8,000. I'm going to use a shortcut here to format it to make a line above it so it's easy. So $8,000 is what they spent. Now, I want to show in here, well, okay, I'll skip that. So $8,000 is the total gross profit on these sales. Now, past that, there are several other expenses this company is going to have, and they're generally lumped as operating expenses, and there are three major segments of this. Research and development is the first one we'll touch on. This would be money you're spending researching other products that are not the main product. So, for example, maybe they're doing some research and considering making sweatshirts or a hat or whatnot. This might be the salary of a person or the portion of their salary, the portion of their time that they're spending researching this stuff. Um, or maybe they're buying special ink and just that part that's specifically spent towards research. And we're going to call that, let's just say when we add all those numbers, they spend $750 on that. Sales and marketing is their advertising essentially, and again, it can also cover the payroll of the people that are specifically dedicated to sales and marketing. So in this case, maybe they're printing pamphlets, they're paying for social media advertising, whatnot. Let's say they spend $1,200 on that. And then general and administrative are just general expenses. So maybe there's their office building that pays rent and the utilities on that building. Maybe it's the main executive's salaries, time, basically things that aren't specifically attributable to the direct cost of goods sold or research, R&D, and S&M. If it's not any of those things, it's probably going to fall under general and administrative. So let's say they spend about $2,500 there. Okay, what that's going to do is I have my gross profit, and I'm going to be able to subtract all the operating expenses. So minus this, and minus this. And that gets me, in this example, 3550. That is called the earnings before interest and taxes. So basically, the operating the business, they're making $3,500 in the year of 2025. After that is going to come interest income or interest expense. So this might be maybe the company has a credit card and they're purchasing stuff and they have credit card fees that they have to pay. Or maybe they have cash in the bank that they're earning interest that is interest income. So this, if the company has a lot of debt, they might have interest expense as well. So that's where this number comes in. It's really more about how the company is financially structured as opposed to the business of selling t-shirts. In this case, let's just assume they spent or rather earned $30 of income from the bank. So now I'm going to take the EBIT, and I'm going to add in any interest, income, or expense, and now that gets me my pre-tax income. And then after that, it's just the income taxes. So again, this is not sales tax. This is the income taxes. So at the end of the year, when they report to the government that they made $3,500, the government's going to send them a bill and say, okay, you owe X percentage in taxes. And maybe in this situation, it might be 30% in taxes. So they might have to pay $1,000 in income taxes. So I'm going to subtract that that $1,000 out of the 3,580 in this case, and then get 2,580. And that is referred to as the net income. So this business that we just talked about is selling t-shirts. They sold $12,000 worth of material, but the net income after all the expenses was 2,580. Okay,